Short squeeze stocks like GameStop and AMC have been tough on long-term investors, but have proven one thing in today's market, that Main Street investors have the power to push a stock higher, and short squeeze investing can make you a lot of money. Case in point, I showed you 4 short-term catalysts that would send shares of AMC higher last October, investing nearly $50,000 for 6,000 shares, and cashed out for a profit over $12,000, a 25% return in just 1 month. And I found 5 more stocks that could be the next short squeeze targets. 5 stocks to buy now before they take off. I want to get started on our list, but stick around because I'm going to explain short squeeze investing, how to do it right, and how to not lose money. You can find a list of the most heavily shorted stocks online, and just going off that, you'd find stocks with more than half the shares shorted, like Microcloud Hologram, Children's Place, and B. Riley. Stocks I wouldn't touch with a 10-foot pole. Instead, I'm only highlighting stocks here with the catalysts and the fundamentals to be good short squeeze investments, like C3.ai, ticker AI. Now, most of these stocks look ugly. C3.ai is down 35% in the last year alone, even as other AI stocks have boomed. But each of these have the fundamentals and the catalysts that can make them good investments, something I'm going to show you how to find later on. For each stock here, first we'll go to the Statistics tab on Yahoo Finance and find the short percentage of float. Now that's the percentage of shares available for trading that are borrowed and sold by short sellers. You can see here more than a third, 35% of the available shares of C3 are shorted. Another important piece here, we're going to be looking at the percentage of shares held by institutions, those big money pensions and funds that hold on to stocks for years. That's important because the shares held by these institutional investors aren't really available for sale. It's one of the clues that could set up a stock for a short squeeze. And finally here, we're going to be looking at the percentage of shares held by insiders of the company. Here for C3, nearly 44% of the shares are held by institutions, and another 9% are held by those insiders. I'm going to explain this in more detail later, how it becomes a short squeeze in the stock and pushes that share price skyward, but altogether, that is 53% of the shares available held by insiders and institutional investors. Investors that are going to hold on to a stock, and 35% of the shares shorted for a total here of 88%. That does not leave much room for the short sellers if they need to rush in and buy back that stock in a hurry. But whenever you're looking for a stock, especially these heavily shorted stocks, you have got to look at the bear case. The short sellers are looking at $120 million the company is burning through each year to fund its operations and investments. That, combined with the fact that the company only has $180 million in balance sheet cash and already owes $62 million in debt, does put C3 on shaky ground. The bears see slowing revenue growth and a higher sales and marketing expense keeping the company from profitability. The net income loss is narrowing, but is still expected to be negative through next year at a loss of 27 cents a share. But looking deeper here, there are reasons to think that the company is turning around. C3 beat expectations easily in the last 2 quarters, seeing the shares surge as a result. And even as that sales growth has slowed, it's still a solid 23% a year, and the company is benefiting from unstoppable secular growth in generative AI, including federal spending programs. The company continues to add to its AI applications and platform and bring on enterprise clients, growing out of that cash flow problem. As we've seen in these last 2 quarters, that has driven strong results, surprised those shorts to a higher stock price. Back to our short squeeze stocks, and next is EVgo, ticker EVGO, with nearly 35% of its shares shorted and 44% held by institutional investors. Now less than 1% of the shares are owned by insiders, which seems low compared to that 9% held at C3.ai, but this is actually more typical of a stock. Most insiders, especially as companies get larger, hold less than 3% of the shares. Now, it does, however, speak to a vote of confidence C3.ai insiders have for their company, holding 9% of the shares, but even without it, all the stocks in this list have heavy institutional ownership and high short interest, which is what we're looking for here. The short sellers here are watching the surprisingly fast slowdown in EV cars sold, down to a pace of 25% last year versus 51% growth in the year before. While the need for charging infrastructure is there, there's also a lot of competition, and all the charging companies besides Tesla are losing money. But while growth has slowed, EVgo is still booking 50% revenue growth and is quickly narrowing that loss per share. It has enough balance sheet cash to last for well over a year, and that bigger picture to electric vehicles is still very good. Consumers have slowed the pace, but 25% year over year is still extremely strong for car sales, and the federal government is pumping billions of dollars into charging station infrastructure. Now here, I also own shares of ChargePoint Holdings for this same reason, those catalysts for EV charging stocks, and we actually see higher institutional and insider ownership here versus EVgo. I decided to highlight EVgo for this video though because it's got that higher short interest percentage, 35% shorted versus 27% here for ChargePoint. So I think both are good short squeeze candidates and good investments, but since it is a short squeeze video, I went with the higher short percentage for this one. I highlighted Upstart Holdings, ticker UPST, recently as one of the best AI stocks in the financial sector, and I was surprised to find it on this list as well. With a huge vote of confidence on 13% insider ownership and 46% institutional, the short sellers are playing with fire on these 34% of the shares shorted. Here, the short sellers are watching rising delinquencies across consumer credit, and you can see here that up to 2.7%, which, while still low, is the highest since 2012. The job market has been especially strong, but is weakening, and shorts are betting that a slowing economy sees those loans Upstart makes default at a greater rate. And while the short side has made money on the stock, this is a leader in AI that could see strong efficiency gains to come. The company is expected to return to 30% revenue growth next year and to book its first net income profit. Now, the next stock on our list has already burned some short sellers and could be about to run even higher, but I want to help you understand what's going on here, what forces a short squeeze, the massive returns you can get from them, and how to find these stocks. Now, of course, you know that buying a stock is because you think the price is going to go up, but by shorting a stock, you can benefit if the price goes down as well. How that works is you borrow shares of the stock from your broker and sell them in the market. Say Mark Zuckerberg has come out as a socialist and says he's going to give half the company to Greenpeace. Okay, just an example, but obviously the shares wouldn't stay at over $500 for long. So you borrow 100 shares from your broker and sell them in the market for the current $500 price, pocketing $50,000. Now you still owe your broker those 100 borrowed shares of Facebook, but the idea here is that in a week, when Greenpeace has given control of the platform to Greta Thunberg to save the one-horned spotted pandas and the stock has fallen to $27 a share, you can buy those 100 shares in the market for $2,700, return them to your broker, and you would have made a lot of money. $50,000 you collected selling the shares minus that $2,700 to close out your borrowed position, that is how short selling works. But when all the hedge funds pile into what they think is a bad stock, the strategy can get broken, and that's where you make money on these short squeeze stocks. Remember, anyone that has borrowed those shares to sell short, they eventually have to buy that stock back to return the shares to that broker. The problem for short sellers begins when the stock price starts heading higher. Let's say that old Zuckerberg takes back control and launches an AI within Facebook that doubles profits and the stock price jumps to $700 a share. That short seller that sold 100 shares for $50,000, now to close out the borrowed stock, would have to buy it back in the market for $70,000 and a steep loss. But what happens when, as we see in the stocks on this list, when 30 or 40% of the shares available are borrowed? What happens when that stock price jumps so much that all the shorts together decide that they've lost enough? They all rush to the market all at once to buy the stock and close out their position. Now all of a sudden you have millions of shares being bought in the market and not enough sellers. There is just such a crush of demand for the stock that the price skyrockets like when GameStop more than doubled in a single day this month. And that is a short squeeze, when all the shorts rush back to buy the stock in a panic, afraid that they're going to lose millions of dollars, even billions. And so finding these short squeeze stocks comes down to 4 simple steps. First, you're going to find the most heavily shorted stocks. Now, MarketWatch or any one of 100 websites will publish this, and you're looking for stocks with at least 30% or more of the float shorted. Now, understand share float is different from shares outstanding. Outstanding shares are just all the shares the company has issued. Float, though, is less. It's minus the shares outstanding that are held by insiders, related parties, and other investors that aren't going to be selling no matter what. So share float is the actual shares available in the stock market to be bought and sold. It's an important metric if you're considering that the pool of short sellers have to go back into that and buy back the stock. Another important metric that we've used here is what percentage of shares are held by institutional investors. These are the big money pensions, the endowments, and ETF providers like Vanguard. These investors aren't active sellers. Instead, they're holding the stock as part of a fund or a long-term investment, so these shares aren't really available for the short sellers to buy back either. So here, you begin to get a picture, like the ones we've seen in these stocks on this list. Short sellers have committed to buying back a large percentage of those shares available, 54% of the shares for our next stock that I'm going to highlight. And to do this, they have to find a seller, but what happens when 63% of the shares are tightly held by those institutional investors and just aren't selling? What happens when there just aren't enough sellers? The third and fourth steps are the most important and something too many investors neglect. Understand, a heavily shorted stock doesn't just jump up and squeeze the shorts. In fact, a lot of those most shorted stocks do keep falling and making money for the shorts. After all, the shorts have a reason for thinking the price is going to continue to fall. That's why after finding these heavily shorted stocks, you need to do that kind of fundamental analysis that we do here on the channel to make sure it's a good company with a shot at rebounding. Now, it doesn't have to be the next hot thing, but does management even have a turnaround plan? Do they have enough balance sheet cash to give them time for that turnaround? Does the company have a good brand and assets that can sell down to pay down some of its debt? And just as important, what or when is the catalyst that is going to push this stock higher? A short squeeze doesn't just happen. The stock has to start going up for the shorts to get worried. So something has to happen to boost that price so much, so quickly that shorts panic and all rush back to the shares. Back to our example here, for that AMC bet late last year, there were so many catalysts. It was a given that one was going to force a short squeeze fast. We had the Taylor Swift concert, the upcoming earnings, the rebound off the share sale plunge, and an end to the Hollywood strikes. 4 catalysts. Those catalysts came through within the next month for a 25% bump in the shares. Nation, I'm getting you started with these short squeeze candidates, finding the heavily shorted stocks with good fundamentals and the potential catalysts, but please do not think you can just get a list of stocks to buy off YouTube and get rich overnight. Put in the time to do your own research. Invest just a select few of the stocks you hear about on this or really any video you see, and you will make money. Back to our list though, with Arbor Realty Trust, ticker ABR, now the most heavily shorted real estate investment trust, with 54% of the shares shorted, while institutional investors hold nearly 2/3, or 63% of the shares. That is 117% of the shares, meaning if all the short sellers needed to buy back their stocks to close out their positions, they may not be able to, and it would trigger a massive short squeeze rally. You can see here that short interest only started building in early 2023, after the Fed started to raise rates the year before. Before then, only 3 to 5% of the shares were shorted on a regular basis, but that number has shot up over the last year. You see, ABR is a mortgage REIT. It borrows on short-term rates and then uses that money to buy mortgage loans as an investment, mostly multifamily apartment loans. Well, multifamily investors took out floating rate loans when mortgage rates were around 4%, but as those loans start to reset with rates closer to 8%, short sellers are betting that default rates increase and ABR has to write down the value of those loans. According to Green Street, multifamily apartment values are down 26% over the last 2 years, and shares of another MREIT, Blackstone Mortgage Trust, have plunged 23% just this year. Shares of ABR are holding up better though, down just 11% in 2024 and about flat over the past year. ABR has been more aggressive at modifying its loans, letting borrowers extend to avoid that default. This kind of extend and pretend is going on everywhere in real estate loans and banking right now, and short sellers are betting that it can't go on forever. But the deciding factor in all of this is going to be interest rates. Data over the last couple of months shows the economy and inflation slowing, and if the Fed starts cutting interest rates, it's going to prop up the real estate market, and that could be the catalyst that drives a short squeeze in ABR. This next stock has a combined 122% of the shares available, either owned by long-term institutionals or borrowed to sell short, an unsustainable situation, and the price has already shown signs of a rebound, but remember, these short squeeze stocks are mostly short-term investments. For longer-term ideas, don't miss this series highlighting the next wave of AI stocks, including this video, the stocks with $1 trillion potential in healthcare. And the most heavily shorted stock on the list, Medical Properties Trust, ticker MPW, with more than 76% of its shares held by insiders and institutional investors. That leaves no room for the 47% of the shares shorted in the market. At 124% total here, there would not be enough shares available to close out those short positions and could lead to a massive short squeeze. MPW is the largest owner of U.S. hospital real estate and has seen the industry suffer under a series of macro pressures since the pandemic. Management has continuously bailed out its 2 largest tenants, extending credit and deferring rents, and it's hit the stock hard, so the shorts have made a lot of money here. But that hospital industry and the company is slowly turning around. MPW has been selling some of its assets to pay down debt, raising over $1.6 billion already this year. Its largest tenant, Steward, is going to put its hospitals up for auction this month, getting operators to take over that can pay the rent to MPW. And all this is coming through in the stock price, up double digits around the last 3 earnings reports and already up 62% from the low this year. Here you have a lot of these short sellers still holding on, hoping the stock falls again, but it may not be long before they give up and that stock jumps in a squeeze. You'll also get special perks like insider access and free courses. But don't wait, the share sale is only open through July 11th, and those shares are selling out fast. Don't forget to tap that subscribe button and click the bell notification.